Welcome to the Holistic Helpline podcast.
Great to be here.
Visit us on the web at www.myholistichelp.com to have a session with a life advisor about your finances, tax matters, legal aid referrals, and mental health well-being.
Definitely check that out.
And please send us your suggestions with the topic you would like us to discuss.
We love hearing from you.
Okay, so today we're diving deep into retirement income and savings. It's a big one. Lots of people wonder, am I saving enough? Making the right calls.
It really is a common concern, isn't it? It can feel like a maze sometimes. Are we setting ourselves up right?
Yeah, exactly.
So this deep dive, we're aiming to sort of guide you through that maze. We'll look at some common pitfalls, offer some insights based on holistic resources.
Good.
We've looked at it from different angles, mistakes people make, savings targets, the impact of things like, inflation, taxes, the whole picture.
Okay, so the mission today, give you practical knowledge, help you feel more confident, less overwhelmed about retirement planning. Sound good?
Sounds like a plan.
All right, let's kick off with something critical. That temptation. Selling investments when the market dips.
Ah, yes. That's a big one. It's interesting to think about the long-term effects if you have to sell a lot of assets early in retirement, especially if the market's down.
Right, because you need that income.
Precisely.
Yeah.
So imagine your portfolio shrinks, but you still need money to live on. You might end up selling more shares than you planned just to cover expenses.
And that makes it harder for the portfolio to bounce back later?
Exactly. It limits its recovery potential. It's sort of like digging yourself into a deeper hole when you're trying to climb out.
That makes total sense. It's not just abstract numbers, it hits your security.
Yeah.
And the holistic view, it stresses being adaptable, right?
It really does. Think about flexibility in your spending. Maybe cutting back on non-essentials or delaying a big purchase if the market's rough.
Like a safety valve.
Yeah, exactly. Having that flexibility gives your investments breathing room, time they might need to recover. Valuable point. Okay, another huge decision. When to start Social Security. You can take it at 62, but should you?
That's such an important question. There's a real trade-off. Claiming at 62 gets you money sooner, sure. But it comes at a cost, a big cost, really. Your monthly benefit is significantly lower than if you wait until your full retirement age, or FRA.
Which is 60 settled for most people now.
57 is for anyone born 1960 or later, yeah. And it's even lower compared to waiting until age 70.
Can you give us an example? What's the difference in dollars?
Sure. Let's say, just hypothetically, your FRA benefit is maybe $2,400 a month. If you claim at 62, that could be cut by 30%, down to around $680. Wow. But if you wait till 70, your benefit could jump up maybe 24% above the FRA amount, so potentially closer to $2,976 a month.
That's a massive difference over a lifetime.
It is. And crucially, those higher benefits, they get adjusted for inflation too. Cost of living adjustments or QLAs. So that higher amount keeps its buying power better over time. Okay, but what if someone genuinely needs the money at 62? Is early claiming ever the right move?
That's a fair point. It really boils down to individual circumstances. Delaying only works if you've got other income sources to bridge the gap.
So savings, maybe part-time work.
Exactly. It's definitely something to talk through with a financial planner. Look at your income needs, your health, life expectancy. Can you actually afford to wait?
Makes sense. What about all the talk about Social Security running out of money? Does that change the calculation? Should people grab it early just in case?
Yeah, people worry about that. It's understandable. The latest trustees report, the 2024 one, estimates full benefits can be paid until the mid-2030s.
And after that?
Well, after that, if Congress doesn't act, they project they could only pay about maybe 79% of scheduled benefits. So potentially a 21% cut.
So does that mean claim early out of fear?
Interestingly, a holistic view might suggest the opposite. If you're worried about Social Security's future, well, maybe that's actually a better reason to save more yourself right now.
Build up your own cushion.
Exactly. Boost your personal savings. That gives you more flexibility and makes you less reliant on Social Security, whatever happens down the road.
I like that. Taking control. Okay, let's shift gears. Turning savings into income. The withdrawal part. Seems like how you take money out is just as key as how much you saved.
Oh, absolutely. It's not just having the pot of gold, it's how you access it strategically. You need to think about timing, how long retirement might last, and crucially, taxes. Taxes on withdrawals from different account types.
Right. Taxes can really take a bite if you're not careful.
They sure can. Once you hit a certain age, currently 73, going up to 75 for folks born in 1960 or later, you have to take required minimum distributions. RMDs.
From traditional 401ks and IRAs.
Yes, those tax-deferred accounts. And those RMDs, that they're taxed as ordinary income. If they're large enough, they could bump you into a higher tax bracket.
And that affects taxes on other things, too.
It can, yeah, like a domino effect. It could impact taxes on your Social Security benefits, any capital gains, dividends, your whole tax picture.
So what can people do to manage that? Any strategies?
Well, one thing to consider is taking some money out of those tax-deferred accounts before RMDs kick in.
Before age 73 or 75.
Right. It gives you more control over timing and amounts, and it could potentially lower the balance that's subject to RMDs later, maybe reducing your future tax hit.
But there's a catch for taking money out early, isn't there?
Yes. Very important. Withdrawals before age 59 and a half from those accounts usually hit with a 10% penalty. So you need to be mindful of that age threshold.
Good point. What about Roth accounts? How do they fit in?
Roths are different. Roth IRAs, Roth 401ks, you contribute with after-tax money, so the money grows tax-free, and qualified withdrawals in retirement are tax-free too.
And no RMDs from Roth IRAs?
Correct. No RMDs during your lifetime from Roth IRAs. So converting some traditional savings to a Roth can be a strategy. Gives you tax-free income later and more flexibility.
But you pay taxes on the conversion amount now.
Yes, you owe income tax on the amount you convert in the year you do it. And there's a 5-year rule for withdrawing the earnings tax-free. So it's a trade-off. Pay taxes now for tax benefits later.
It's definitely complex. Okay, let's hit the big question. How much do we actually need to save?
$1 million question, right? And honestly, everyone's situation is different. Goals vary. But benchmarks can be helpful, kind of like guideposts to see how you're doing.
Can you share some of those benchmarks?
Sure. One common guideline you hear is aim for 1 times your salary, saved by age 30, then 3x by 40, 6x by 50, 8x by 60, and maybe 10x by age 67.
Okay, 10 times your final salary by retirement.
Yeah, but remember the assumptions behind that. It often assumes you start saving young, like 25, save 15% a year, including any match, invest heavily in stocks, retire at 67, and want the same lifestyle.
So they're aspirational targets, not set in stone.
Exactly. They're helpful milestones, but your specific number depends. When do you want to retire? Someone aiming for 70 might need less, maybe 8x. Someone wanting to retire earlier, say 65, might need more, perhaps 12x.
And your spending matters too, right?
Absolutely. Your lifestyle goal in retirement, below average, average, above average spending, hugely impact your target number.
Are there other ways to look at benchmarks?
Yeah. Some look at multiples of your current salary, like maybe 1x to 1.5x by 35, 3.5x to 5.5x by 50, and 6x to 11x by 60. The ranges reflect different incomes and situations.
So lots of variables.
Right. But the key takeaway, really, is action. Even if you feel behind, start now. Save more if you can, cut spending, maybe work a bit longer. It all helps.
That's good advice. Progress over perfection. Now, once you're actually in retirement, managing the money day to day, budgeting must be crucial.
Oh, absolutely essential. Especially since people are living longer. You need a plan. A good start is splitting expenses into needs and wants.
These being the must-haves: housing, food, healthcare.
Exactly, the mandatory stuff. And wants or wishes are the discretionary things: travel, hobbies, dining out.
Okay, so you list those out. Then what?
Then you compare those total expenses to your guaranteed income sources. Pensions, Social Security, maybe rental income. See how much your investments need to cover the gap.
And factor in things like maybe selling a house later.
Yeah, don't forget potential future income like downsizing. It's about building a realistic picture.
How do you estimate those future expenses accurately, though? Life changes.
Good question. Start with your current spending. Look at bank and credit card statements. Get a feel for your monthly outflow.
Okay.
Then think about how things might shift. Commuting costs might drop. Healthcare or travel might rise. Factor in occasional big costs to car replacement, home repairs. It's about anticipating your retirement lifestyle's costs.
Planning for your future self, based on today, but adjusted. Got it. Now, something unavoidable. Inflation. How does that sneaky factor mess with our retirement plans?
Yeah, inflation is it's a constant pressure. It slowly eats away at your savings buying power. $1 today just won't buy as much down the road.
We've felt that lately for sure. Has the U.S. seen really bad inflation before?
Oh, yes. There have been several periods since World War II, often tied to things like, big demand surges, ending price controls, or those energy crises in the 70s.
I have heard about the 70s inflation. How high did it get?
It peaked around, believe it or not, almost 15% in 1980. 14.7%.
Wow. That's a serious erosion of value.
It is, and it highlights why you have to factor inflation into your retirement projections. Your expenses will likely climb over 20 or 30 years of retirement.
But Social Security helps with that, right, with the CLAs?
Yes, thankfully, Social Security benefits usually get those cost of living adjustments, which helps protect their purchasing power against inflation. It's a valuable feature.
Okay, good to know. So we've covered saving, spending, inflation. Let's loop back to taxes again, specifically traditional versus Roth accounts.
Right, understanding the tax treatment is fundamental. Traditional accounts like traditional IRAs, 401ks typically give you a tax break now. Your contributions might be tax deductible.
Tax-deferred growth.
Exactly. But withdrawals in retirement, taxed as ordinary income. And eventually, those RMDs kick in.
And Roth is the mirror image.
Pretty much, Roth IRAs, Roth
Duh.
401k, you contribute with money you've already paid taxes on after tax.
So no tax break up front.
Correct. But the big payoff is tax-free growth and tax-free qualified withdrawals in retirement, which can be huge.
So the choice kind of depends on whether you think your tax rate will be higher now or later.
That's a big part of it, yeah. But you also have to consider state taxes. They treat retirement income differently sometimes. And there are income limits for contributing directly to a Roth IRA.
Right, if you earn too much, you can't put money straight into a Roth IRA.
Correct. For 2024, for example, single filers have income limits. Above a certain modified adjusted gross income, or MAGI, you can't contribute the full amount, or maybe none at all.
But there are workarounds for higher earners, like conversions.
Yes, things like the backdoor Roth IRA conversion exist, though they have their own rules and potential tax wrinkles. It really shows why getting personalized advice can be so valuable to figure out the best tax strategy for you.
Absolutely. Okay, wrapping things up slightly. Are there any simple rules of thumb for just how much percent we should save overall?
Yeah, people like rules of thumb. You often hear suggestions like saving 15% or more of your gross income. That should include any employer match you get. Don't forget the match.
Definitely don't leave that free money behind.
Never. Others might say 12–15%, honestly. The best rule is probably save as much as you reasonably can without making your current life miserable. Your goals matter too. Aiming for early retirement means you'll need a much higher savings rate.
Makes sense. It's personal. Okay, one last area. Mistakes younger people make. These lessons seem relevant for everyone, though.
They really are. Probably the biggest mistake. Just waiting too long to start. Compounding is magical, but it needs time. Starting early makes a massive difference.
What else?
Not contributing enough to get the full employer match in a 401k.
Yeah.
We just mentioned it. It's free money. Leaving it on the table is a huge unforced error.
Absolutely. Any others?
Yeah, just contributing too little overall, even beyond the match. Aiming for that 15% total over time is a good target. Also, being too conservative with investments early on.
Keeping it all in cash.
Yeah, or very low-risk stuff. When you've got decades, you can generally afford to take on more growth potential, more stock exposure. Another mistake is forgetting about other accounts beyond the 401k.
Like IRAs or HSAs.
Exactly. IRAs, health savings accounts, which have triple tax advantages if used for healthcare, but can also be retirement funds. Even taxable brokerage accounts have a role. Diversify your savings vehicles.
And one final big one, cashing out when changing jobs.
Oh yes, please don't do that. Cashing out your 401k means immediate taxes, probably penalties, and you completely derail your long-term compounding. Always look to roll it over into your new employer's plan or an IRA. Keep that money working for your future self.
Great points. Really valuable for anyone saving.
Definitely lessons for all ages.
Okay, this has been incredibly insightful. Let's try to recap the big takeaways. Stay flexible with spending, especially if markets dip. Delaying Social Security, if you can swing it, pays off long term. You need a smart, tax-efficient withdrawal plan.
Right. And use benchmarks as guides, not rigid rules. Budgeting for retirement is crucial. Don't forget, inflation and taxes, they're real.
And avoid those common mistakes like not getting the match or cashing out early. Proactive planning and just, keeping informed seem key.
Absolutely. It's about taking control and making informed choices along the way. That's the foundation for a secure retirement.
Well said. So here's a final thought for everyone listening. Considering everything we talked about, what's maybe one small, doable step you could take this week to feel a bit more in control of your retirement journey?
Good question to ponder.
And please keep sending us your suggestions for future deep dives. We really appreciate the input.